Welcome to Investors Guide. Thank you so much for tuning in. I know it's been a harrowing week for those of us who've invested in equity through mutual funds or maybe even directly. But don't worry about it. We're here like we always are at the end of the week to help you through this time. And of course, if you have a question, you can get in touch with us at the bottom of our screen. That is our email ID. On the show this week, we will first figure out what you should be doing in a market like this and what your strategy should be for your mutual funds. In our product review, a lot of investors are worried about the rating of HDFC Equity. It's down to 2 stars on Value Research. We'll find out why. And we talked to Maria Morris, Executive Vice President of Global Employee Benefits at MetLife, about what employees in India really want and what they should be getting. All right, let's bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on the show. We had one conversation on Monday when the Sensex was down a little over 1,600 points, and it seemed like a really scary time for investors. I understand if there were investors who were really worried that day. Post that, the market recovered a little bit, but we've largely had a volatile move. Now, for those of us who have our life savings in mutual funds, this might seem like a harrowing time. What is your advice at this point?
No, at all times, as I keep saying that, it's not worthwhile to time it. And yes, it was a manic Monday. It was a black Monday, being, widely referred. But I don't think any of it is in your control. In fact, incidentally this time, it had nothing to do with India, but our markets, most markets are connected, or on a short-term basis, it is extremely difficult to predict where the markets will be. So you have nothing else but to just ignore such events. Of course, it's very hard to ignore that when you see your investments, all your accumulation, the value going down by 5-7% in a day. It's very difficult to, resist the temptation to look at it more closely, be anxious about it. And also, but nothing can be done about it. It is not, in fact, most of the rewards which is derived from equity, or investors derive the higher return of investing in equity is derived as a result of, one should look at it is that this is the tax that you pay. You have to stay put with all this anxiety. More importantly, as if somebody is following the advice carefully and takes it to his heart, takes it seriously, then you should be, you have few things in your control. Invest your long-term money, invest regularly, and don't put your short-term money and ignore the noise. And be in good investments, and don't try and time it to perfection. It is not possible. I think most fund managers could not call it. No fund manager had expected this. So I don't expect any investor to benefit from it. It could be, if somebody has benefited, it could be a sheer chance. And I don't think investors are they should be looking at themselves as traders. On a short-term basis, the markets could be guided more widely, even in coming weeks and months. Resist all your temptation to look at it more closely.
In fact, Dhirendra, I want to understand what your outlook is on this market. For investors right now, would you say that we're going to continue to see volatile markets for the next couple of months at least? Because while it was not reacting to India, it was reacting to what was going on in China. Those problems still persist. So do you think that we're going to continue to see some more volatility? Is the worst behind us?
I think so. The worst seems behind us, but you never know. You still have very special events coming, or they're likely. The Fed rate hike or review, that's still 2-3 weeks away. And that can cause another, scale of panic or anxiety. And you never know what is the, we know so little about the factual stuff about China, which is driving the market right now. China is not something which we can ignore, or the world can ignore. It is one of the biggest guzzlers of all the things that is produced, and it is also a supplier of most of the things produced in the developed world. So it's a very significant economy. And if it suffers, and suffers dramatically, the unfortunate part is that the Chinese government trying to intervene in it, and that creates distrust. The other part is that the transparency of the market. We know in India generally or tentatively what is the general state of the state of the economy, state of the different components of the economy, how bad it is or how good it is. I think there is a general higher scale of distrust in the data that we get from China. So we can keep getting surprises. Here is the economy which has grown phenomenally and consistently over the last 20 years, and suddenly it's in trouble. and suddenly it's facing a deceleration, and it has to combat that deceleration. I don't know what all is hidden and how the market will react to it. But still, I feel that, if you get a 10% decline, I think it will be a buying opportunity or an opportunity worth ignoring, because I don't think it is going to affect India or Indian investors fundamentally.
All right, so this is the advice you're getting. Invest only your long-term money into equity. Do not invest any short-term money. Do not worry about the short-term noise, because then you're a long-term investor and you're only worried about what happens to the market over the long term. Also, you cannot time the market as an investor, so don't attempt to do so, and there's no benefit from attempting to time the market. This is advice that's not specific to this week. This is advice that we've been giving you for the last 6 years. So fundamentally, for you as an investor, nothing changes. You should just continue investing in your SIPs. In fact, Dhirendra, we have a question from Prabhakar, who's written in. He says he wants to invest 10 lakh rupees in this current market condition, and he has a 5-year horizon. What should his investment strategy be? This goes against everything you just said. He's putting in a lump sum amount. He's only investing for 5 years. Would you like to tweak his investment strategy a little bit?
Yes, a lot of investors might be looking at this as an opportunity, but I would still like to, err on the side of caution, because there could be bad times ahead, there could be turbulent times ahead, and it is worthwhile missing on a small opportunity, but getting distracted from a plan, which could be very scary. Because if you invest today, all your 10 lakh rupee, and you are faced with a 10% decline, and just in case you get very nervous and you exit, I think you would have lost a lifetime opportunity. So just to moderate, just to ensure that you don't run away from the market, which has turned very volatile, I would say that invest your 10 lakh rupees, spread it over the next 12 months, and invest in a balanced fund. Keeping this, and balanced fund doesn't mean that you are, balanced funds are almost like an equity fund. Right now they are about 70 to 75% into equity, but they don't crumble, they don't collapse, and you will be able to reasonably participate. And also the fixed income component is also earning very substantially right now, and we have the likelihood of upside even there. So it's a good time to be investing in a balanced fund with moderate risk for your time frame as well.
I'm going to run those balanced funds on your screen right now. Again, remember, do not invest a lump sum amount, especially in a market like this one. If the market reacts to something again tomorrow, you might wind up losing a large portion of that money you invest, which is why it makes sense to spread that investment out. Coming up after the break, Dhirendra is going to stay with us. We'll talk about HDFC Equity Fund. We're getting a lot of questions from you about the rating of that fund and why it's dropping. We'll find out from Dhirendra on the other side of this break. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. It's time for us to look at our product review, and this is why we've picked this particular fund. Om Goenka, along with several other investors, Dhirendra has written in telling us he's been investing in HDFC equity for the last 5 years. He says he built a corpus of 3 lakh rupees in the fund. He's worried because it's come down from a 5-star fund now to a 2-star fund. And he got more and more progressively worried as the star rating fell. He wants to know what he should do now. If we quickly take a look, and I'm going to put up some of the performance on the screen, it's not a bad performer, Dhirendra. Why is its star rating falling on value research?
No, in recent times, it has been a relative underperformer in its category of large and mid cap, large and mid cap fund. And understandably so. The fund has taken a position that it's in a kind of stocks or in a set of stocks which, other funds, which is very different from other funds of similar kind. And the fund has taken a view, and the fund has generally been right on key occasions in the last 20 years. It looks like one such occasion. And things haven't turned out to be very favorable for the fund. And on a relative scale, this fund has struggled. But I think it's just 1 year, that is all in the last 1 year. Otherwise, you look at any other time period, and if you look at any discrete time period, the fund is not at all disappointing. Last year, 2014, it was among the top quartile. It was able to deliver reasonable return. It has taken a view, and I think on all such key occasions in the last 20 years, this fund has suffered before it has succeeded. So I would say that investors should, do 2 things. One is that hold this fund anyway, It has too compelling a track record and not a very disappointing performance. If you look at it, yes, on a relative basis, it is disappointing. Relative to benchmark, I think this fund has beaten in 19 of the 21 years or 18 of the 20 years it has existed. So that is good enough reason. The fund manager remains, the same fund manager has been managing the fund for all these years. I don't think his I would not call it brilliance, but I don't think his his ability to look at things broadly at the same time on a tactical basis can be questioned. The one thing which most investors should do is, many investors I have come across, or in the course of answering their questions which we get here, is that investors hold HDFC Prudence, HDFC Equity, and HDFC Top 200, and that makes up their portfolio, and they think that they're very well spread. I don't think it's a good idea. I think investors should spread their risk across one or two fund managers. But I would not, and this fund has been disappointing in recent times. The fund has taken a view, but I think it is a bit early to call quits from this fund. Hold on to this.
All right, hold on to this fund. There's over 18,000 crore rupees in this fund as assets under management. We're going to continue to review it on a regular basis on this show. And if there's anything to worry about, I promise you will hear it first on Investors Guide. Dhirendra, give us your star rating for Investors Guide for the HDFC Equity Fund.
I would say that it is definitely struggling for a while. I would give it, if one is considering a fresh, I would give it a 3-star, an average fund as of now. But long term, it's still very difficult to ignore this fund.
All right, 3 stars for HDFC Equity on Investors Guide. If you're a long-term investor, Dhirendra Singh, stay invested. There's nothing to worry about right now. We're keeping a very close look on this fund. It's just the short term. Over the last 1 year, the returns have been disappointing, but it's unfair to measure the fund over just 1 year. So we're going to continue to watch it for you. And if you need to make a move, we'll tell you when to do it. Let's move on to our hold or sell segment. 47-year-old Swapnil has written in, Dhirendra, he wants to build a corpus of 1 crore rupees in just 8 years. And an additional 1 crore rupees for his retirement. He sent us a list of his portfolios, of his mutual funds. Now, he's making a decent investment into these funds. He's putting in 20,000 per month into 2 funds, 10 into the third and 5,000 into the fourth. But is this enough to hit his target of 2 crore rupees? The first on his list is the Canara Robeco Emerging Equity Fund. Continue this investment?
Yes, this is a very impressive mid-cap fund and worth continuing for aggressive growth.
SBI Blue Chip is the next on his list, Dhirendra, 20,000 rupees a month going in, and these 2 funds form the chunk of his portfolio. Would you recommend he continues the investment in that quantum?
Yes, in fact, this is a large cap fund, and it has turned out to be a very impressive large cap fund.
Next on his list is the Tata Balanced Fund with 10,000 rupees a month and the Reliance Small Cap with 5,000 rupees a month. Is he on the right track with both of these funds as well?
I would suggest that the best way of building a fund portfolio is to keep it simple, keep it in a manner that choose funds which are relatively low maintenance. He has chosen 1 small cap fund, 1 balanced fund, 1 large cap fund, and a mid cap fund. I think choosing a large and mid cap fund with a fairly flexible mandate, 2-3 of them will be good enough. But he has chosen good funds. If we look at Tata Balanced, it's a good balanced fund. It's a fairly conservative balanced fund. But I don't know for this time frame if it's a great choice. Likewise, Reliance Small Cap could be disappointing on occasion. So if he's not getting anxious with the returns or ups and downs of these funds, it's fine. More so with the small cap fund. Otherwise, I feel that there is no such need. SBI Balanced and Canara Robeco Emerging Equity makes it a complete portfolio.
All right, so that's excellent. You have a complete portfolio on your hands. You don't have to change anything. 2 thumbs up to you. If you'd like us to take a look at your portfolio, write to us on the email ID that's at the bottom of your screen. Dhirendra, thank you so much for joining us.
Thank you.
Especially on a week like this. It's always nice to have your advice. When we come back after this quick break, we'll talk to Maria Morris, Executive Vice President, Global Employee Benefits at MetLife. She'll tell us what is Indian employees we should really be asking for in terms of benefits. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide and ET Now. Thank you for staying with us. I spoke to a very interesting person this week. Executive Vice President of Global Employee Benefits at MetLife, Maria Morris, just released an employee benefits study that's been done in the Indian market. It's basically a study about what you and I want as employees from our employers as far as benefits are concerned and what's being provided right now. Maria had some interesting solutions for us as employees and investors. Take a look. Maria, thank you so much for speaking with us, and welcome to India.
Thank you.
I want to understand, for you, when you looked at the research, and you've been looking at similar research from across the world, what was the most striking point about, about employees in India right now?
First of all, 70% of employers are saying retention is a real issue for them. And what we found is that employee benefits is one way to actually help attract and retain and engage employees. 47% of employees tell us that they are going to be leaving their employer in the next 12 months.
Hang on, so is that I'm going to leave for sure, or I'm looking for a better opportunity?
I think it's I'm looking for a better opportunity, okay. And if my employer was able to create a package that I would want to stay, I would stay.
Okay, and what would they say was the biggest reason for that?
I think they're looking for more opportunity, maybe better salary. 62% said a better salary would have them consider staying with their employer, but 55% said a stronger benefits package would have them stay with the employer. And that differential, 62% versus 55%, is the smallest differential we saw across many markets. So benefits matter everywhere in the world, but even more so here in India.
The thing about benefits in India is that it's a very loosely defined term. We don't really know, across the board, whether you work for an MNC or you work for an Indian company or you work for the government, benefits are defined differently. So when you spoke with employees who said that, if my employer gave me a better benefits package, I might stay, or that would be reason enough for me to stay. What do they mean by benefits then?
It's a great question. I think obviously the mandatory benefits, people have a good understanding of the mandatory benefits that are offered, but these are really the voluntary benefits, the benefits that employers can choose to offer. There are things like group term life insurance, things like Medigap and different types of medical supplemental programs, accident insurance, different types of retirement plans beyond the Provident plan. So it's really where employers can make a differential and add value, an employee value proposition that they're not just going to get from the mandatory plans that the government's offering.
Have you found that employees know enough about what they already have? Because sometimes that tends to be a problem.
I think that's a great point. And what we find is that employees don't necessarily know what they have. Benefit communications have not been that strong. So as an example, when we asked employees if they have life insurance through their employer, about 2/3 of them said they have life insurance through their employer, but only 30% of employers are offering life insurance. So they believe they have life insurance. If something was to happen to one of their colleagues at work, they would then say, oh my goodness,
we don't have
it. Yeah. And so that would be even worse for an employer than had they actually thought they didn't have it and got to get it offered to them.
This is a slightly, unkind question to Indian employers, but in comparison to the rest of the world, how far behind are we when it comes to offering benefit packages to our employees?
What we find is that financial security is on the minds of employees all over the world. And specifically here in India, what's stronger is the fact that people want to be secure if they were to pass away. They want their families secure. So what they say is that's the top financial security worry for them. In other parts of the markets, other parts of the world, they already have life insurance through their employer. So it's probably less of a concern for them because they already have the coverage. Here in India, people are concerned because they don't have the coverage through their employer. So it's an easy way for an employer to actually add value to the total employee value proposition by offering something as simple as group term life insurance so that people can actually either get the benefit from their employer or even pay for it. Many employees say that they'll pay for it.
They're willing to pay for it. So what you're saying basically is as an employer, if I were to offer my employees life insurance, they might actually consider staying on, because if I leave that insurance policy, then I'm no longer covered and I'm going to have to buy a policy of my own, and that's enough of a retention strategy right now.
Absolutely. Life insurance with flexible packages so that we offer more different types of benefits so that depending on where someone is in their life and what their obligations are, that they can choose to purchase additional benefits through the worksite as they need it.
What about areas like childcare, creches, maternity leave, maternity benefits, things like that? How far behind, or where's the mismatch there between what employees want and what employers are offering right now?
Yeah, it's a great question. And I think basically employers really need to ask their employees more about what matters. We do see that a flexible work environment comes out in the study is important. So,
and this is across the board?
Across the board. Okay. And it's really a lot of things. It's things like caring boss. So, in a situation like that, it's not just that the person that they work for is friendly and nice. It's about the workplace and how friendly and flexible is the workforce. So is there flexible time offered to employees? To your point, different types of benefits for maternity, et cetera. And then how is that coupled with what the benefits look like that they can purchase? So as an example, if you have a broader set of benefits, if you are a young mother and you're out on maternity leave, you might have more of an interest in some of the life insurance programs that you would not have had interest in as a single employee right out of university.
So have you also noticed that, okay, if employees have said that, listen, if my employer or my boss were to offer me a better package of benefits, I'd stay. Does that also mean that if someone else were to offer me a better package of benefits, I would leave just for the benefits? Is that also true?
It's certainly what I would believe is happening, because if you look at salaries, you can only go so far with salaries, and yet retention is not as high as it should be in India. So there's got to be other factors in terms of why people are moving to other opportunities. And I do believe, based on the data we have from this research, that benefits is a big reason for it.
What's your advice to employers who are watching right now? One, obviously, from what I've gathered, is that they don't survey enough, they don't ask enough, they don't communicate enough. Would you recommend that that's something that all employers should take on?
I think all employers should take it on, and it should be very flexible and multiple ways of communicating. What this research showed us is that well over 80% of employees said that they wanted to be communicated with in different ways. Digital, face-to-face meetings, educational meetings at the work site, better booklets, written booklets that explain their benefit programs. So they want a multi-pronged strategy for being communicated to. The second is protection matters. So there's so much focus on things like healthcare as an example, but protection products matter. Financial security is the #1 concern of employees. Group term life is in the marketplace. We don't have to create products, they're there. So employers focusing on really balancing out their benefit offerings to include financial protection products is a big thing that they can do as well. And then looking kind of holistically to say, how do I put together a total rewards package that includes salary, but includes benefits, includes career pathing, and other things that are important to employees as they make decisions about whether or not they want to stay with the employer.
All right, so communicate, get the packages and educate your employees about them. That's
exactly.
what we're leaving with.
Exactly.
Maria, thank you so much for joining us on the show.
Thank you for having me.
Thank you. So remember, if you have any questions, you can always write to us. Our email ID is at the bottom of your screen, and you can reach me on Twitter as well. A copy of this show will be uploaded on our Facebook page. Tune in next week to catch Investor's Guide. Thanks for watching.